Welcome to our regular 6-minute strategy and a very happy Christmas from me, Guy Munson. 2023 is drawing to a close with clear disinflationary trends evident across Western economies. Indeed, forecasts now suggest that US and European inflation will end 2024 close to central bank targets of 2%. A benign outlook for prices coupled with a US economy that is only gradually deaccelerating means the probability of a near-perfect soft landing is rising. In response, Chairman Powell at this month's Federal Reserve meeting gave the clearest signal yet that the Fed's historic tightening program is all but over. Against this backdrop, we expect US rates to fall next year with 6 cuts in 2024, starting in April, and a further 4 in 2025. The ECB and Bank of England will likely follow the Federal Reserve with rate cuts, but for the moment, despite weaker economic data, they're sounding more hawkish. This argues for further dollar weakness as the tempo of US rate cuts is faster than in Europe or the UK. For asset markets, inflation that is trending back to target with only a modest cost to growth is a powerful combination. The near Goldilocks outcome caused us first to lift our corporate bond exposure, and we're now following this through with a move to overweight equities, where we see a broadening out from last year's technology and AI-centric rally. We'll look at this in more detail in the slides ahead, so let's begin with a brief recap of the outlook for 2024. In terms of growth, we expect demand to moderate by the end of the year, with US growth deaccelerating to 1% in the first half of the year and then re-accelerating in the second. We expect something similar in Europe and the UK, although growth could effectively stall at the end of this year and early Q1 2024. In inflation terms, it's good news. Base effects and supply chain improvements, coupled with falling energy prices, should contribute to sharp falls in headline inflation. Easing labour demand should also help. In terms of interest rates, this should allow the Fed to cut 6 times in 2024 and a further 4 times in 2025. The big risks were probably politics. Global conflicts are on the rise. Tragic wars between Israel and Hamas and Ukraine, Russia, alongside ongoing conflicts in sub-Saharan Africa, are very painful, but I must say, at least for the time being, they're relatively well contained. So what does this mean? It means probably the Federal Reserve moving from a single mandate, that's just fighting inflation, back to its more traditional dual mandate of fighting inflation, but also stimulating growth. So let's look at this inflation data in a little bit more detail on the left-hand panel. You can see the dramatic falls in consumer prices around the world, with the UK back down to 4.6% from over 11%, and the Eurozone rate now down to 2.4%. Now, central bankers will want to see progress too on the core rate, that's ex-food and energy. That's about 1% higher than the numbers I've shown you here. But generally, the direction of travel is very encouraging for 2024. It's been assisted on the right-hand panel by the extraordinary moves in oil prices, down not up, which is counterintuitive, looking at the conflict, that red line, the Israeli-Hamas invasion of the 7th of October. Now, though the tragedy of the conflict and the conflict in Ukraine and Russia are clear, but so far they haven't mushroomed out to the rest of the global economy and haven't resulted in any sort of oil embargo, as we've seen in previous Middle East crises. Let's look now at what this means for interest rates. I showed you this chart last week. It's the forward projections from futures markets where interest rates are going. You can see US rates, that dark blue line, down to around 4% by end 2024, and then gradually drifting down to 3%, broadly a neutral rate by end 2025. And that being mirrored, albeit a little bit slower, in the Bank of England and the ECB. That's very encouraging numbers for the normalisation of interest rates overall. What does this mean for global portfolios? Well, the first thing we've done is increase exposure to UK corporate bonds over the last few months. Yes, yields will come back from over 6% to around 5% today, but as you can see in that left-hand panel, that's still very attractive compared to levels we've seen over the past decade, and spreads over gilts remain robust and attractive, particularly as corporate earnings look relatively solid. The second implication is probably for sterling and the dollar. The likelihood that rate cuts come sooner and faster in the US could put pressure on the dollar and allow sterling to begin its gradual normalisation after the traumas of the Brexit years. You can see in that dark blue line the purchasing power at parity estimate, that's estimate from the World Bank, of 144 that would equalise the price of 2 baskets of goods against the rates today of 126. Now, we don't think we'll narrow all that gap, but we'd like to see sterling up in the 135s before we took profits on our positions. What then does this mean for equities? Well, for full year calendar 2024, the earnings outlook is comparatively attractive, between 11 to 13% across Europe, North America and Asia, across all these regions. And that's after the strong moves in technology that we saw in 2023. On the right-hand panel, dividend growth looks attractive at 8.4%, very powerful against underlying inflation rates that will be falling through 3% and below. Finally, in that bottom right-hand panel, I've shown still robust share buybacks. So the total return to investors, particularly of dividend-friendly equities, is encouraging. And this will be helped all the more if the tight technology AI-led market of this year expanded out into something wider, more income-focused in 2024. Finally, what are the risks? Well, we mentioned politics before. The conflicts, I'm afraid, only worse in Mali, in Ethiopia, in South Sudan, Ukraine, and between Israel and Hamas. And I've shown in that left-hand panel the horrific rise in deaths in state-based conflicts by region, with the Middle East and with Europe and Africa rising strongly. I'm afraid that number is going to be even bigger for 2023, as of course we factor in the huge casualties that we've seen in Palestine and in Ukraine, Russia. The other political risk, of course, is the Trump presidency marches on, and the polls are beginning to widen really quite sharply in Trump's favour, with a lead particularly robust in 7 swing states. So I think we've got to factor in a Trump White House as a risk for end 2024. So what does this mean in summary? Well, we're holding our bonds neutral, overweighting our corporates because of those attractive spreads, and underweighting the governments because a lot of the rally has already occurred. We're pushing equities overweight, expecting a broad income and dividend-based rally for global equities in 2024. In alternatives, we're neutral correlated holdings, particularly infrastructure, and underweighted or uncorrelated hedge funds and absolute returns. We've still got a position in gold and in carbon and transition metals. We've drawn on most of our tactical cash to add that to global equities, and we hope that will put a powerful growth driver behind your portfolios in the year ahead. Well, I hope that's helpful. Good luck in your investing in 2024, and thank you and a happy Christmas. Best.